started. So today we're going to talk. First, we're going to talk about land loans because you can't have a construction loan if you don't own the land. So we're going to talk a little bit about land and lending and how to go about that. And then we're going to talk about construction loans. There's really three types that we're going to talk about. There's strictly a construction loan where you just finance the construction. When you're done building the home, you've got to get a permanent loan. And we don't do many of those. They're expensive, and I don't suggest getting one, but we're going to talk about a little bit about them. And then what's more typical is a custom one-time construction to permanent loan, where once you own the property and you've got permits and you've got your plans completed and you're ready to build, then we step in and provide a loan for the construction cost. And when you're done with construction, you keep the loan if you want. I mean, maybe interest rates go down and you can refinance into a lower rate, but you keep that loan for another 29 to 30 years, depending on how long it took to build the home. And then we'll talk a little bit about speculative construction loans. This is for people that just simply want to build a home and sell it. And there's a lot of money in that right now because we're really running short on home inventory. And if you look at the statistics, we're about 5 million homes behind in construction in the United States. And we're falling about 500,000 homes behind more every year. So we're not even breaking even. We continue to underbuild in the United States, and I can talk a little bit more about that a little later, but that's why I think there's a lot of money to be made in construction because, again, you can sell a home quickly, construction costs have come down, and there's a lot of new technologies that are being applied to home construction that are bringing labor costs way down, and I'm in the middle of designing and building a home in Colorado, so I can speak to that quite a bit. I'm not going to do that today, but there's some exciting alternatives to bringing the cost of construction down to something reasonable. And then we're going to talk about renovation loans. Renovation loans we used to talk about fix and flip, or maybe you just want to buy a home. It's not your dream home and you want to add on to that home. Or maybe it's a dilapidated home and you can get a good deal on it. And we can come in with the money to buy the home. We can come in with the money to renovate the home. And then you can end up with a lot of sweat equity kind of into the home. And that's where real money is being made and has been for a long time in renovation loans. So let's start off with land loans. So a normal construction loan does not cover the land purchase because you don't have the plans and the permits to build. So nobody's going to lend you a construction loan if you really don't have plans. I mean, what do we lend you? We don't know what it's going to cost. We don't know what you're building. And right now, there is no national lender offering land loans in the state of Hawaii. I actually don't know of any land loan lender that offers land loans, in the 48 states. I don't know of a single one. They've all left the market. Land loans are the most risky loans, and they take the most amount of time with lenders in monitoring them. So basically, you have to go to a local lender. That's the only source that I know of, and it's very limited. So, like, if you look at Bank of Hawaii, First Hawaiian, American Savings, Central Pacific, they're not offering land loans. There are a few in Hawaii. Some community credit unions offer land loans. They're certainly not for expensive pieces of land. Most of the really expensive land loans are being offered by buyers, private banking sources like Goldman Sachs or something like that. And land loans used to be you could borrow 80%, but that's no longer. The most you're going to get is 50 to 70%. That's the most you're going to get. I offer up to 70%, but we have a cap of $750,000 on a land loan. That should be fine for most people. The rates are expensive. They're at 9 to 9.25. And remember, a land loan is a short-term loan. It amortizes over 30 years, but it balloons after 1 year, 2 years, or 3 years. So you can't get a land loan and just sit on a piece of land for 15 years unless you're willing to pay that land loan off. So land loans are tough. They're very tough, and they're expensive. But my opinion is you should never purchase a lot until you get pre-qualified for a construction loan. I have a client right now, bought a lot, a very expensive lot, designed a home, and there's no way I can do the construction loan because they qualify for about 50% of what they're asking for. So they didn't think through the pre-qualification of getting a construction loan. And they thought that they were a slam dunk, but they're not. So now they have a piece of land, plans and permits for a home they can't afford, and a home they can't get a loan on. So now they either have to sell the lot or dramatically downsize the home and redesign it. So it's important that before you buy a piece of land, think about what you're trying to do, and we'll make sure that you can qualify for the eventual construction loan. And I can't tell you how many people I see are stuck with a piece of land that they're never going to get a construction loan for. So they got ahead of themselves. Now, if you're trying to borrow money to buy a piece of land, the lender will not lend to you unless you provide them with an idea of your plans, and then they're going to pre-qualify you for the construction loan. If you don't qualify, they're not going to give you the land loan because they're not going to get stuck in a loan where you have no opportunity to be qualified for the eventual construction loan. Another thing I would suggest, never pay cash for land. Once the money's in, you can never get it out. Lenders do not offer cash out on land loans. They just don't do it. So it's kind of a one-way door. You can put money into a piece of land, but you can't take it out. So the only way to get out of a land, of the land, is either build a house or sell it. And again, I've seen so many people that get into a lot they pay cash for, and they have no way of building a home, and now their money is stuck, and it's earning a 0% rate of return. So it's just not a good place to invest money. You always want to borrow the most that you can. If you need more than 50 to 70, if you can't afford a 30 to 50% down payment, consider asking the seller to carry back until you have plans, permits, and an approved construction loan. So there are people that are stuck in their piece of land, and they may consider to carry you at, let's say, 80%, you put 20% down. They may agree to carry you for a year so you can get your plans completed and your permits completed. So that's another alternative that I would recommend. And you might get a better interest rate. 9% is not a great interest rate. But always borrow as much as possible when you purchase a piece of land, even if you have the ability to pay cash, unless you're super wealthy and you don't really care. Now, if you purchase a piece of land that has permits and plans that you intend to use, you can get a construction loan out of the gate and never do a land loan. That's the only condition where a construction loan can help you buy land, is if it's, we call it shovel ready. If the permits are valid, you have architectural plans and you have a bid from a contractor to build the home, then you can do a construction loan. That's the only condition in which a construction loan can help you with land. So there are no loans that do land, construction, and permanent all in one loan. They just don't exist. Okay. Okay, so we're going to talk about residential construction loans. So there are such things as construction-only loans. Mainly they apply to the spec construction building. And this is a loan that is interest only during construction. And when the home is done, you got to pay it off, and usually through a refinance. This loan is much more expensive because the lender knows that they've got to make their money in 12 months or whatever, 18 months. And so they're going to charge more points and they're going to charge a higher interest rate. I've never done a construction only loan on a residential property where people plan on staying in that property. I've never done one. I've only done them for spec construction. Most loans are construction to permanent loans. So this is one loan. They provide you the money to build the home. You pay interest only during construction. When you're done building the home, it converts to a fully amortized loan. Some lenders, if you spend a year to build the home, then you've got to pay it off over 29 years. And there's some lenders that once you're done building the home, it converts to a 30-year amortized loan. A little bit different, but most of the Hawaii lenders are, it's one loan for 30 years. And so if you spend a year building, you get 29 years left on your loan. Then there's spec construction loans. Now on spec construction, this is where you plan to just build a home and sell it. It's an investment. You're a real estate developer per se, and you just want to make the margin between the cost of building and the current market price on homes, especially if you apply some of the newer construction techniques where you can, I have a source where you can build the shell of a home inside and out for about $200 a square foot versus maybe $400 or $500 a square foot. So you can make some money in spec construction if you do it right. Now, you don't need to qualify for the loan based on income that you would normally need to hold that loan. So the lenders aren't necessarily saying, you've got to make enough money so that you can keep that home indefinitely. They're looking at your liquid assets, they're looking at your experience, and they're really looking at your FICO score too. Now, they will ask you for tax returns, but you're not qualifying to support the payment on that home. You're qualifying based on the ability to get it built and hold it for a certain amount of time before you sell it. Now, spec construction loans come at a higher interest rate. You're looking at 9 to 10%. And of course, the lender doesn't make any money. Doesn't make money for 30 years. They're only making it for 12 to 18 months. So they charge points, and you should expect 3 to 4 points. It's almost hard money, but these are really geared for construction. Now, most of those lenders do require that you're experienced in, the person that's borrowing the money is an experienced builder borrower. So they've done this before. It's not their first rodeo in building a home. Now, with that said, we do have lenders that do allow first-time home builders to build a home as a spec construction. Your credit scores are very important, and your day-to-day income is important to show that you're pretty savvy. And then all construction loans nowadays are based on the project cost, not the eventual value of the home. It used to be back in the 2006, 2007, if you were going to build a home that, let's say, would eventually sell for 1.5 million, they would lend off the 1.5 million. And let's say it only cost you 1.2 million to build that home, you could almost borrow 100%. That's long gone. You need sweat. You need to have skin in the game, and so most lenders are really basing everything off cost. They like to know what the home's going to be worth when it's sold. As long as it's going to be worth more than what it cost, then they're going to lend the money. But they're going to make sure that you've got skin in the game, and you have to expect 20 to 25% down payment when you're building a home. And the project costs are really simple. It's just the cost of the land plus the cost of construction. Sometimes lenders will allow you to include architectural fees and permit fees. Some don't. Some that's a cost that they're not going to cover. So just think of the total cost as being cost of land, cost of construction, and they're going to loan you maybe 75% of that number, 80% of that number. Some go to 85, and we're going to talk about those lenders that go to 85. Okay. Do we have any questions so far? Alex? Okay.
No questions in the chat.
Okay. And again, please unmute if you've got a question up to here. So let's talk about a normal residential loan where you want to go build your primary residence or something like that. Most of the local lenders will lend you 80% of the cost, up to about $1 million. When you go above that, $1.5 million, they'll lend 75%, and up to $2 million, they'll lend 70%. So the higher you go, the lower the loan to cost that they're going to offer you. And that's pretty typical of all loans, So if you were going to go buy a $4 million home, it's already been built, you've got to put more as a percentage than if you were going to buy a $1 million home. So that's just typical in the lending business, where the higher the cost, the less they're going to loan. Now, one thing you should pay attention to is bonding. And what bonding is an insurance policy that is given to you and the lender, that if anything happens to your builder, they get hit by a car, or they get in a car accident and they're gone, or they leave the state for some reason, that the bonding company will finish the construction and honor the contract that the builder signed with you. So that's not a bad thing. I mean, it's a good thing. But it really does cost money, because the bonding companies are usually the supply houses like HPM, Hansdorff, Pacific Source, and they require you to buy all the materials that at least they sell from them. And they don't give discounts, so you're not going to get a discount, and you can't shop your materials. So, a lot of builders like to buy materials on the mainland and put them in a container and ship them over. And you can usually save 10 to 15% of the material cost by being able to shop on the mainland. So the local supply houses are about 15% higher, maybe 10% higher. So you got to think about that. Now, we have lenders that don't require bonding, and depending on the size of your project, that could be tens of thousands of dollars. So that's an important thing to think about. I like the local lenders. They're good at Hawaii construction. They know the builders. They've got local inspectors to inspect progress, but they do require bonding. And, again, bonding can be a big deal. We do have construction lenders, if you can believe this, go all the way up to like 35 million. And they do tend to be better than on the loan to cost than the local lenders. So, where a local lender might be at 70% on a $2 or $3 million build, we might be able to get 80%. And we don't require the bonding typically. So depending on the size of the project, you might steer yourself to some mainland lenders rather than local lenders. But I do like the local lenders. Their rates are good. They do require bonding, but if your project is pretty small, you're probably not going to container materials in anyway. So it might be a moot point that you're going to buy from the local supply houses anyway. So that's an important thing with residential construction loans in Hawaii. On the mainland, I don't know of any state in the United States that has bonding. I haven't run across that before. It's a Hawaii thing. It might be an Alaska thing, but I know it's not typical where lenders require bonding. So it's just something that's typical for Hawaii and really nowhere else. So let me give you an example. If you want to build a home, let's say that you came to eMortgage Hawaii and you want to buy a piece of land. We would get you a 70% loan. You would have to put $75,000 down to buy the land. And then let's say you spend the next year getting your architectural plans completed, your permit, you negotiate with a contractor to build the home. And let's say the contractor is bidding $900,000 to build the home. Well, the lender is going to require a contingency above the 900 of about 10%. So they're going to say, we're going to assume the project is really 990, and that's what you're going to have to borrow. You're going to have to borrow enough to cover the contingency. So when you look at the total project cost, it's $250 for the land, $900 for the construction cost. And sometimes when a builder bids a project, they already put a contingency in there. So we won't overlap that. If there's a contingency in their bid, we'll take into consideration that contingency. But if they don't, we're going to add another 10% typically. So if you look at the total project cost, you might feel that you're going to be in at about 1,150, but we're going to make sure that if there's any problems, you can go up to 1,240. So that's the project cost, 1,240, and we can lend up to 80% of that. There are some sources that may go to 85, but those are much more expensive loans, and I don't think it's worth it. So we'll lend you $992,000. That loan will take out your construction loan, which will be about $175,000, and provide you enough money to complete the home after you come into closing with another $173,000. So in this scenario, you've put $75,000 down. You got to come in with another 173. So basically you're at what, 250. That's what you have to put in the project, $250,000 to build the home. Now, there's some ways to come up with that money. Let's say you own real estate currently, then we can get a home equity line of credit or refinance that property and pull some money out. So that's always another way, to get the down payment for the construction. You can also bring in a family member to gift you some money to help you with the down payment. Okay, any questions to this point? Okay. Okay, so how do you qualify for a construction loan? It is not the same as a residential loan. So most local lenders require you to qualify for the construction loan while you're carrying the debt of your current home. So it's kind of twice as hard. So if you think about it, if you let's say you have a home where your principal, interest, taxes, and insurance are $5,000 a month, and the new home that you want to build will end up costing you $7,000 a month, then we look at your total housing expenses at $12,000 a month. So in order to qualify for the construction loan, you have to meet a debt to income ratio of 45%. So we take the 12,000. This is assuming you don't have any other debt, no car loans or no credit card debt. If you do, we'd have to add it to that $12,000 number. So in order to qualify to build that house that will have a $7,000 a month principal, interest, tax, and insurance, you've got to make 26,000, call it $700 a month. So they don't let you assume that after you build your home, you're going to sell your current home. They don't allow that. And that's where a lot of people get stuck after they've purchased a piece of land. Then they go to the lender and say, I want to build a home and I can afford a $7,000 a month payment, but the lender is saying, well, yeah, you can, but you can't afford the $12,000 a month. And that's where they get stuck. Now, a lot of times I kind of coach people through the process. If they're in that situation where they absolutely want to build a house, if they own a current home, they'll probably have to sell it or put it into a rental situation to cover the cost of that monthly payment. And, or if they're renting, they'll actually, if you're renting, lender's going to count that rent just as if you had if you owned the property and you had principal and interest. But if you don't qualify, what we have our clients do, either rent their current property out and move in with family where you don't have to pay rent, and we have to prove that. Or if you're renting, is to leave the rental and move in with family where you don't have a rental cost. And that way we can qualify you, even if you get the construction contract and your parents say, or your family says, get out and go rent someplace else. But at least you get to qualify for the construction loan. And that makes a big difference. You go from, you're required to make $26,000 a month, and now you're down to $15,000 a month to qualify for the construction loan. So there's some things we can do, but this is a real big issue with construction loans, is trying to juggle both homes at the same time, or a rental property and the new home at the same time. And that's the way most lenders look at it. Now, there are some lenders that have, they're a little more flexible. If you got good FICO scores, a good work history, good income, they'll bend the rules. But generally, this is an issue that we all have in building a home. Okay. It used to be a lot easier when you had stated income construction loans, but we don't have those anymore. So, that product is gone. And you got to remember, lenders consider land and construction their riskiest loans. Those are the riskiest loans that they can offer. And that's why a lot of lenders got out of both land and construction for many years after the 2008 downfall. Okay. So how do you qualify for a construction loan? It's just like, if you were going to if you're going to purchase a home, I would need all this information. We're going to send you all a copy of these slides. But this is basically it. You got to prove your income with tax returns. If you own your own business, we need the business tax returns. We need to see your assets. My feeling is, if you don't have enough for the down payment, think ahead. If you've got family members that will help you, go ahead and get a gift, put it in your bank and season it for 2 months. That's the best way to do it. But you got to have the assets to build the home, to do the down payment, cover the closing costs. And you also need reserves for a few months of the principal, interest, taxes, and insurance. So we got to verify those assets. And then if you have current real estate, we have to document the mortgage payment, the property insurance, the property taxes. If it's in an HOA bills. And if you've got rental property, we would want to see lease agreements. So it's a pretty arduous, typical, loan when it comes to qualifying. But then we have to add the property that you're going to build. And we need all of the information from the property you're going to build. Either you send us digital plans, or we need 2 complete sets. Now, the architectural plans have to be stamped by the county, the architect, or engineer, and the client. So we need a final set that everybody agrees to. This is it. The county's approved it, they sign off. Even if you have an HOA, the HOA is going to sign off on it. You have to sign off on it, and the architect has to sign off that this is the full set of plans as to be built. And then we need the specifications. Now, the specifications are, what are you building? Are you going to build with marble or vinyl flooring? Are you going to build with, Costco cabinets or custom cabinets? We got to go through the specifications of what you're building, because the lender is going to do their own evaluation of what it should cost to build that home. And they do that through an appraiser. You also need a construction contract. And the construction contract has to be on a standard American Institute of Architect form. And you can either do disbursements by the percent completion, or you can do a monthly disbursement. And most lenders require you to have the final payment to the contractor when the home is done, at least 10% of the contract. So the contractor can only be paid 90% of the cost to build the home until the home is done. Okay. If the property is in a planned unit development or an HOA, we need a copy of the CCRs and approval from their design committee that they've approved the property. And then lastly, if you're using a local lender, we need the bond. It has to be 100% of the contract amount. And there are some builders, I just want to forewarn you, there are some builders that the supply houses will not bond. So the very first thing you want to ask your builder, can you get a bond? If you can't get a bond, you better ask why. That's a big question. Was there a problem in the past? If you feel comfortable with them, but they still can't be bonded, and to get bonded through a supply house, they have to pledge assets like their house, or if a house has a lot of equity in it, so the supply house is putting their financials at risk if they don't complete the home properly. So make sure you select a builder that can either be bonded, or there's a good reason why they're not being they can't be bonded. And then we can bring in a lender that doesn't require bonding, but we really want to talk to the builder why they can't be bonded. Now, there's a lot of builders out there that can be bonded, and they would love not to provide a bond. And they're going to love you if you get a loan that doesn't require bonding, because now they can not only shop the materials for you, but they don't have their assets pledged to the supply house, that if something goes wrong, they could lose their home. I mean, that's the truth. Okay. You also need a building permit. And then we also need what's called course of construction insurance, so that during construction, you've seen it on YouTube where a home is being built and there's a big storm and it is just being framed, and the frame collapses and they have to start all over. So there are things that can happen during construction: theft, fire, storms. So you want to be protected, and that's called course of construction insurance. Okay, so that's the basics of a construction loan for a normal homeowner building their home. I want
I
to just
have a question.
Yeah, go ahead.
Yes.
Go ahead, Stacy.
Yeah, so what if you're planning on building like a small house, really small house, but you're planning on trying to just do an owner builder?
Yeah.
Is that possible?
Yeah. So I don't know of any lender that does owner builder loans. You have to get a permit, and you can't get a permit unless you're a contractor. So, the question is, how are you going to go get a permit? The county normally requires you to be a licensed contractor. Now you could have a friend that's going to offer to go get your permit. And what I would suggest for you, if you want to, there's a lot of people that do this. And so let's dive into this for a second.
I was going down that road. That's why, because I do have a friend that signed off and he's a contractor.
Right. Okay. So this is friends of the family that they'll
Local style,
Yeah, they'll pledge their license, so they're going to trust you, but they also have to sign a contract that this home is going to be built for X. And what I suggest to you is have a contract that any builder would say, yeah, I can build it for that. But if you're going to come in and let's say you're pretty handy and you know how to frame or do electrical or plumbing or whatever, so you're going to put some equity into the project and your builder is okay with that. So the guy that's providing you, that permit is okay with you doing work on the weekends or evenings or whatever. And we see it all the time. It happens all the time. As long as the inspector from the county, when they come out, that they sign off and say, hey, it was done in a professional workmanship-like manner, then you can save a lot of money, of course, but your loan has to cover the cost of construction as if you were never involved. Okay, so let's say I'm going to give you an example. Let's say you're going to build a home for $400,000, a small home, and because you and Stacy are going to do a lot of the work. You're going to drywall and paint and help with the framing or this or that, and you can get the home done for $300,000. We still need to get the loan to cover the $400,000. But if you don't use it, you don't pay for it. So if at the end of construction, the home is done, the county signs off, and you've only drawn $300,000, no harm, no foul. The lender's fine with that. So then your permanent loan is only going to be $300,000. The extra $100,000 never gets used. So that's the way we typically work with people that are kind of in the business or in the trades, and they want to do some of the work. Now, the thing I want to warn you about exceptionally small homes is most lenders will not lend on them. So what do they call them? Tiny homes. They're not going to lend on a tiny home because it's not typical of the market. So when they get an appraisal done, they're not going to do the loan unless they get an appraisal done. And they're going to ask the appraiser, is this typical for the market? And we need at least 3 comparables of homes just like it. If you can't provide that, you're not going to get a loan. So I think the rule is you got to do something standard, something that is in the market. It can be small, but it can't be something that's atypical. Does that make sense?
Crystal clear. Thank
Yeah.
you. Yeah, I was just gonna build some like garage and like a 900 square foot ohana on the behind that. So That's
can
in the
do
market.
that. I mean,
Yeah.
a 900 square foot Ohana is, we have lots of homes in 900 square feet. I mean, there's no question about that. And with the garage, I mean, it's quite a bit. And then eventually, if you want, you can build a bigger home separate from the Ohana. That's a great way to go. Or,
Yeah, that's the
another
plan.
building that you could rent out or something like that. But it's got to be typical though, and you got to do your research so that you know that there are other properties in the area that have something similar. Especially I think you guys have a
Good comps.
property that have a lot of acres. If there's if you got 10 acres and you're building a 900 square foot home, are there other properties in the area with that kind of acreage with a small house? I mean, you just got to
Yeah.
keep it consistent. Yeah.
No,
So,
thank you very much.
yeah, excellent. That's a good question. I mean, we get that a lot. So there are ways to work around this sweat equity issue, and we do it all the time. But your construction loan is going to assume that all of the work is being done by a third party that's getting paid. So you're going to have to qualify for a bigger loan, and then don't use it. Yeah. Okay. Any other questions to that part? What time are? Okay, I gotta speed this thing up. Okay. So we did that. So spec construction loans are a little bit different, and then I'm going to end the presentation on fix and flip or renovation loans. So speculative construction loans are usually for real estate developers. We don't need the borrower to qualify based on their tax returns able to support that mortgage and property tax and insurance for a long period of time. That's not why it's being built. It's being built to sell. But we just have to prove that the builder or the borrower's got enough money to hold it for a little while they're trying to sell it. These are short-term loans that are more expensive, usually 9 to 10% interest, and expect to pay 3 or 4% in points. Again, most lenders do require some experience in building and selling a home. Now, there are some lenders that will cater to a first-time home builder, but the costs are a bit higher. And normally, a spec lender is going to require 20 to 25% of the cost of construction. However, you can get up to 85% if the property is going to appraise for a much higher number than the cost to build it. So let's say you're going to build $1 million home and it costs $1 million with land and construction, but it appraises for 1.3, then you might get up to 85%. So and we have lots and lots of lenders that do these kinds of loans, mainly mainland lenders that do this. And remember that they're doing quite well in construction because construction is so far behind. A lot of people are making money in construction, especially if you can employ these new techniques to reduce your installed cost per square foot. Again, I'm looking at a concept in Colorado where I was given an estimate on the cost to construct at $600 a square foot, and I'm going to get it done for $300. And so there's some new techniques out there that are being employed to lower the cost of construction. Okay. Renovation loans. Now, this is a really important aspect to the, making money in residential. So it is we have conventional loans with conventional rates, like 0.75 to 7% without a bunch of points or anything like that. They're offered by Fannie Mae and Freddie Mac. The borrowers can finance the purchase and the repairs and improvements with a single loan. So you can buy a property, fix it up, expand it, all with one loan. Borrower contractors will complete the repairs of the subject property, but you have to do it with these conventional loans in 6 months. So you've only got 6 months to get it done. What happens if you go longer? They complain, but they're going to let you finish. But it's got to be. It's not going to be building 4,000 square foot addition or anything like that. Contractors receive payments after completing work and repairs. Usually it's a monthly draw. And the good news is there's no bonding on renovation loans. Now, this is the good part of a renovation loan. I think I've got too many zeros at the end of that. We can lend you up to $1,209,750. That's going to go up by about $50,000 in a few weeks. We can lend you 90, if it's going to be a primary residence, we can lend you 95% of the cost to purchase, and we can lend you 95% of the cost to renovate. If it's a second home, we can lend you 90% of the cost to purchase and 90% of the cost to renovate. If it's an investment home, we can give you 80% of the cost to purchase and 80% of the cost to renovate. Now, let's say you own a home and you want to renovate, and there's not enough equity in the home right now. We can, again, if it's a primary residence, we can lend you 95% of the current value of the home plus 95% of the cost to renovate the home. So this can be done not only as a purchase, but if you just want to renovate your home, we can provide you that capital with only 5% down. Now, there are jumbo renovation loans. They're more kind of like the speculative loans. You can get up to 85% loan to cost. Generally, the lenders like to see more down, but so those renovation loans you got to put a little bit more down, but you're looking at borrowing the money to renovate. So once you go over 1,209,000, your down payment is going to go up. Now, when you're doing a renovation loan, obviously, if you're buying property, don't buy the highest value property in the area, especially if you're going to add to the value. You don't want to overbuild for the neighborhood. I see that quite a bit where, people go into a neighborhood and they really build a Taj Mahal in an area that shouldn't be there. And you don't want to spend money on items that won't add more value, like pools are kind of notorious. They're very expensive, and they typically don't add the same amount of value that it costs to add a pool. You also want to do a very thorough inspection, foundations, wiring, the structure. I've seen people that get into a renovation and they open up the walls and they've got a miserable situation that the costs go up and they're in a really bad situation. The best thing is to add square footage, bedrooms and bathrooms. Great kitchens add value. You don't want to overspend on that, but there are some homes that have really crappy kitchens, and you add on to the kitchen. Landscaping is really tricky. Again, it's hard to add value through landscaping. If you do anything with landscaping, focus on views if you can get them. And my last recommendation is hire professionals. The amount of money you spend with somebody that has, a professional eye on interior design and the design of the home. I walk into a lot of homes where builders design their own home, and you can tell the second you walk into that home that a builder designed the home, because it's just not done professionally as an architect. So, again, don't design to your taste, design to what the market is going to value. So, okay, if you look at the conventional renovation loans, you can add up to 50% of the current market value of the home. Let's say you buy a home and the completed value is going to be 1.4. You can add $700,000 to the home. You can't buy a $500,000 home and add $700,000 to it. They're not going to allow that. Yeah.
We do have a question. Can an ADU or an Ohana be added with a renovation loan?
If it's attached. So you need a breezeway, you need something attaching it. But that's a really good question. I think they were going to change that. I don't know if they ever did. I'll look into that. But generally, an Ohana has to have a breezeway so that it's connected to the house. And you can do that quite simply. But that's a great question. But you can add as many square feet as you want, as long as it doesn't break this 50% rule. And you can add a pool, you can do landscaping, you can do a lot of things. But the one thing they don't do is allow you to build a completely independent second structure on a conforming Fannie Mae, Freddie Mac renovation loan. Okay, and you cannot get cash out in a renovation loan. You can cash out once the home is done and it's got a higher value. It is offered on 1 to 4 units. We don't have a lot of multifamily units in Hawaii, but you can do that, and you can do condos. So the subject property has to be existing or new. The condo, you can completely renovate a condo if it's dilapidated. So condos, manufactured homes are not eligible. And you do pay mortgage insurance if your loan amount is above 80%. Again, if you do the right renovation and it adds a lot of value, you can refinance at the end of the renovation and get rid of the mortgage insurance. So that's always a possibility.
And then, Kurt, it looks like question of what is the interest rate?
Interest rates are just normal Fannie Mae, Freddie Mac conforming loans. You're probably going to be, you might get 6.5% right now, maybe 6.75. Rates have been coming down. I haven't done a renovation loan in a little bit, so they're a little bit higher than if you were going to purchase a property, but they're not much higher. So they're decent rates. They're not like spec construction or anything like that. So you're going to be in the 6s if you got good FICO scores. Okay, so just remember these numbers. The limit for conventional conforming renovation loans, 1.2. You can borrow 95% of the cost to buy the home, 95% of the cost to renovate the home. If you're doing 3 or 4 units, it's 80%. Second home, 90%, and rental properties would be 80%. And I have a client that I did a lot of business with on Oahu. He would do 3 or 4 of these a year. And he was making a couple of $100,000 per deal. And he wasn't doing anything. He was finding a realtor to buy the home. He had a contractor to renovate the home, and then the realtor to sell the home. All he was doing is working with me to get the loans. So he would sit at home and he was making $600,000, $700,000 a year. It was amazing. It was just, he'd go deal after deal after deal after deal. So let me give you an example. Let's say you buy a property for $1 million. It's going to cost $200,000 to renovate. And the total cost of the sales price plus renovation is 1.2. So, and it appraises completed at 1.5. And this is not atypical. I mean, this is what renovation loans are all about. So if you borrow 95% of the cost, you can borrow $1,140,000. You come in with $60,000 plus closing costs, probably about $15,000 in closing costs. So you got a total cash involvement of $75,000, and you can even have a family member gift you that money. Now, if you sell it for 1.5 and you pay a 6% commission and net 1,410, something like that, then, and the cost are $1,215,000, you can net a couple of $100,000 on one transaction that took you 6 months to purchase, renovate, and sell. And that would be a kind of a typical deal if you do it right. Now, does everybody do it right? No, they have had a lot of shows on fix and flip, but and again, these are loans that you can keep the home, you can be your home, and you've just built up some equity by renovating the home and improving it. Okay, so the loan process, you select the property, the lender, and you got to have a licensed contractor. You receive a fixed price bid on the renovation from the contractor. The lender reviews the contractor's resume, plans, bids, and approves the contractor. We get a HUD consultant involved to inspect the property. The HUD consultant is also going to agree that the property can be renovated for whatever the contractor has agreed to. An appraisal is completed as an as completed value. So they're taking into consideration what you're going to do. And then the lender will confirm the loan amount and underwrite the loan and clear you for closing. So it's pretty straightforward. It's pretty quick if you've got a contractor involved. Once you close the loan, the renovation work begins. Usually permits for renovations are pretty quick. So you got to get that permit in and approved. And generally there's a predetermined draw schedule that the lender is contacted each time a draw is required, and that's usually every 30 days. The lender asks the HUD advisor to go out to the property, confirm the work was completed. Then the lender will release the funds, usually to the borrower and the contractor. So you both have to sign. And at the end, you can't get any cash back. So if you don't use all the money, the unused funds are used to pay down the principal. And so the property itself, it can be dilapidated, which means it's not in a livable condition, but it can't be a complete tear down. It can have health and hazard problems like loose balconies, but the contract has to address the health and hazard problems as part of this, what they're going to do. If it has unpermitted additions, those unpermitted additions have to be included in the permit. That once completed, the county will permit the unpermitted additions. And then there's some other issues like shared road access, shared water meters, generally not allowed. Shared cesspools are not allowed. If it's off grid, it's a little harder. You can't have farming activity on the property. But it can have a leaky roof or termite damage as long as the contractor is going to address those problems. And I'll tell you, a lot of people make money in fix and flips. I mean, this is where generally the seller has to accept a cash offer. We can come in with a loan and you can buy the home, fix it up and sell it. And there are a lot of people that just do this for a living. That's all they do. Okay. I'm just going to open it up for any last questions. And then I do want to talk about another upcoming webinar that we're going to offer, but let me first answer any remaining questions. You can unmute if you want. JR, did you have a question?
I do have a question. So say, for instance, if you want to do a foreclosure and you want to do a flip on a foreclosure. So it's the same process as a renovation type of loan where you just go in there and just buy, because a lot of the foreclosures they require cash. So I guess, do you get your loan first before you go buy that foreclosure?
They say that they're going to require cash, and then we come in with a pre-approved loan. We do it all the time. And they usually require 10% at the auction. So you've got 10. I just completed one, and a lady bought a condo. It was worth about $990,000. She paid $748,000 at the auction. We had already approved her for the loan. She went into the auction with that pre-approval, and they accepted her offer. We closed on time. It was the same kind of thing that she had to fix it up a little bit, and she made a couple of $100,000 on a condo, fix it and flip it. Yeah.
Wow, that's good.
So, yeah, I mean, they say they're not going to accept it, but if we come in with a pre-approval letter, usually you can get it done.
Okay, great. Good to know. Thank you.
Anybody else? Yeah, if you have any questions that you don't come up right now, just take my number. Usually I'm more on my cell phone, 808-896-6800. And then in 3 weeks, October 18th, I guess it's a little further out. I'm doing a webinar with a realtor friend of mine, and we invite realtors to be part of this. She's just going to offer some information about properties to look at and things to watch. But we're going to do a seminar on wealth building through real estate. And the key to this seminar is if you include real estate into your wealth planning, I can show you how you can, only use your money one time to buy your first home. And from then on, you allow the real estate to grow more real estate. So basically it's a 5-year rule. What this process is, the real estate grows in value, and you can use that equity that you generate in the growth of the value of your real estate to buy more real estate. And if you do this, you can end up with, $5-10 million worth of equity in real estate if you just do this every 5 years. So we're going to go through the mathematics of this. It doesn't require you to put any more money in real estate once you've owned a piece of real estate. And it's just a leveraging process. And that's how virtually all wealthy people become rich, is through leverage. So this is on October 18th from 11 to 12 on a Saturday. Just contact Alex at eMortgageHI.com, and you can attend this.
Thank you.
All right. Okay, everybody, go have a great weekend and cheer for the Denver Broncos tomorrow and not the San Diego Chargers.